Good morning, everyone. Welcome to our Spring Budget and Tax Planning webinar. My name is Marie Pegram. I'm a partner at Recruitment Accountants, and I'll be facilitating today's session. I'm probably chipping in my own thoughts on the budget announcements and some tax planning for 2023-2024. It's the conversations that I have a lot with our clients. And I'm really excited to be joined by one of our tax experts, Ali Price. Ali, please can you introduce yourself and let us know what your overall thoughts were of the budget yesterday?
Good morning, Marie. So I'm Ali. I'm also a partner with Recruitment Accountants, specialising in tax. My thoughts on the budget yesterday, no big surprises there really, was there? Nothing, definitely a pre-election budget. No big shocks. Some interesting things, the higher income benefit charge, obviously 2% on NI, so he's focusing on the workforce rather than the population as a whole. But the slight surprise, I suppose, on the capital gains tax, which we'll discuss later, being slight reduction, but overall nothing very exciting.
Yeah, that's a good positioning for our webinar today. I promise you that we will be giving you some key announcements on how, and also some tax planning as well. But yeah, I agree with Ali. There was no surprises whatsoever in the budget. I think they've kept it quite safe. I think the thing that with Jeremy Hunt, we started off with his statement of more investments, more jobs, better public services and lower taxes. I think that's quite a statement from the Conservatives ahead of that upcoming election, which is going to be called before January 2025, so it must be held before then. But just to give some context around where we're at the moment in the economy, so inflation was about 4.2%, I think, in December 2023, and it's predicted to go down to 2% by the end of June, which is good news for us. And that's quite a stark contrast, I think, from this time last year, where it was at 11–12%. We've got interest rates that are currently 5.25%. I think the next review is due on the 21st of March, and that hopefully they've peaked, fingers crossed. And I think with the inflation going down, that we expect the interest rates to drop. And also, from off the back of yesterday, the Office for Budget Responsibility predicts that the UK economy to grow by 0.8% this year and 1.9% next year. And I think based on talking to lots of clients, I don't know whether Ali, you may have seen this as well, and various different experts, confidence is starting to build, I think, this year. Last year was a pretty tough year for a lot of recruitment companies. Employment rates remain high, unemployment's still low. And we've got the elections on the horizon. I think it's worth mentioning that some of the announcements that were made yesterday may take effect next year and onwards, and that could be dependent on whether the Conservatives are staying on, and we'll sort of know more about that later on this year. But today's session, we're actually going to focus on the announcements that are certain to come into play, and how, and we're going to be focusing purely on the recruitment sector and recruitment business owners only. And how these may affect you. And we're also going to then look at the tax year ends coming up at the end of March, so 5th of April. So what can you do as a business owner to save a bit of tax, making sure you're doing all the right things before the tax year has ended? Please feel free to ask questions as we go along. We'll try and answer them as best we can. If we don't, we'll definitely follow up after this webinar and either give you a call or drop you an email with the answer. So I'm now going to hand over to Ali. He's going to talk through the key announcements that may affect you. Over to you, Ali, and I'll see if I can try and work this PowerPoint at the same time as well. It's too much technical going on this morning.
Oh yeah, I'll let you get the slide up first.
So there we go.
Yeah, so yeah, the big one, I guess, is he had talked in the pre-election conversation, the pre-budget conversations about a 2% cut in income tax. He just couldn't afford to do that, so the cheaper option to him was to reduce the NI. So we saw at the autumn statement, he announced a 2% reduction from 10 to 8. That came into force on the 4th of January. So we're already seeing the benefit of that in workers' payslips. And that is going to be reduced further for your employees from 10 to 8, going down in April this year coming. Self-employed, a further 2% again, 8 till 6. And the class 2 for self-employed only is still intended to be abolished by the 6th of April. So the big thing there is a 2% reduction on workers' NI, whether you're employed or self-employed.
So I'm just going to say, I think that's quite a big impact on the recruitment industry, especially if you've got PAYE temps as well. It won't directly impact your profits from a recruitment perspective, but it will certainly help your temps and your in-house team as well. And I think I was listening this morning about Jeremy Hunt alluded to possibly he wants to abolish NI altogether, which I found really interesting.
He definitely said that.
Yeah, and merging, I don't know whether it's merging national insurance and income tax, but I guess that's something to watch out for if the Conservatives stay on. And I guess that'd be something that would be a complete change in a couple of years' time, possibly.
Yeah, I feel that this reduction here is like his sort of baby steps into reducing. He wants to reduce taxes. He said that they want to be the Conservative government that reduce taxes. But within the constraints they've got at the moment, they're starting with the NI option. But the overall effect is they want to see more cash in workers' hands at the end of the day. So this is what they're doing. So again, reiterating what you just said there, Marie, for those of you with temps, PAYE temps, this is going to mean something to them.
Yeah, definitely. And the next announcement that may impact people.
Yeah, absolutely. So a contentious issue for many years, a high income child benefit charge. So the way it's worked in the past, a bit of background, I'm sure those of you with children may well already be familiar, but if you have a household and you have anyone owning 50k or more, they start to lose their child benefit. And it's reclaimed through their tax return if they're claiming it. So this came in several years ago now. I know it's several years ago because I still had young children at the time and my children are fully grown now, so it's been a while. But it meant that it dragged a lot of people into self-assessment. So it didn't matter, you could have 2 people in one house earning under 50k, you would keep all of your child benefit. But if one person in the household went over 50k, even if the other person wasn't earning any, you would start to get a clawback on this child benefit. It's been deeply controversial for many years. So I'm not surprised that they brought it in here because I feel like they're going for the vote, if I'm honest, with this change. So what they're doing here is they're increasing that threshold. This is an interim increase. This is what's going to happen immediately from the 6th of April. So they're going to increase the initial threshold to 60k, which means that if you've got 2 adults in a house earning up to 60k, you would potentially keep all of your child benefit. But if one of them goes over 60k, they'll start to lose it. And interesting, they've also increased the taper threshold from 10,000 to 20,000. So where it was 50 to 60 before, it's now 60 to 80. So between the earnings of 60 to 80,000, you'll start to lose your child benefit allowance. And once you get to 80,000, you won't have any. It'll all be really fully reclaimed. So this is interesting for those of you that are pitching your salaries so that you are keeping yourselves well within or just above the basic rate band. I think it does apply. So it's going to mean quite a few more people might look at whether or not they've done the correct thing and opting out completely. I know that there's a situation where you can opt, you're still in the child benefit, but you're not claiming it. So it might be time to look at what your earnings are this year, look at whether which we'll talk about later on, your remuneration strategy, whether there's anything there to tweak that to get it to 60,000 to start retaining that child benefit, which could be beneficial to you. As I said, it's a transitional change. So the plan is, and obviously this is going to be post-election because this is a 2026. So this is kind of kicking it into the long grass. But the plan is that it will move to a household income threshold as opposed to on an individual. So we don't have that weird situation at the moment where you might have one household earning under the old rules, 99,000 across 2 salaries, but in another household earning 56,000 on 1 salary, and the second household losing their child benefit, but the first household keeping it. Now, the reason they've given themselves a delay here is that the HMR systems need to be updated so that they can access the household income, which is a very different mechanism to looking at people's salary. Obviously, they've got through the RTI system, through the payrolling information that they've already got. So that's what they've given themselves. That's why they've given themselves a little bit of time there. It became clear yesterday, to anyone that listened to the budget, that Jeremy Hunt is a tech fan. He loves tech, so he's obviously looking at the systems and he's improving systems, and I think that's what he's pushing with the household income threshold. He's looking at, you know, rejuvenating HMR systems so they have the ability to do more in-depth tasks than just simply on someone's level of pay. So that was interesting.
I think the household income threshold is far better, because, you know, I speak to owners of businesses where you're looking at, you know, trying to bring your spouse into your business to make sure that you both keep under that threshold, as opposed to one earning a lot and the other one not earning anything.
Absolutely.
So yeah,
it's been
the other aspect of high income child benefit is your top billers within a recruitment firm. We did a blog recently, well, not recently, actually, it's about a year ago, I think, about making sure that your top billers realise that they're going to lose their child benefit if they earn over a certain amount. And again, if they have opted out, Ali was mentioning that that does mean that you may have to opt back in.
Yeah, well, light on the details, as to how that's going to happen, but it's definitely something to look out. And as soon as we have those details, obviously we will blog again, won't we, on what needs to be done for these people that wasn't relevant and now back in child benefit. So that information will be out. It obviously only happened yesterday, so it's a bit vague on what this actually means, because there were people that stayed in and took a risk because they weren't 100% sure about what their salary would be every year, so they were happy to pay it back through the tax return. Obviously those people might be the people that benefit immediately from this, because the information is there, they'll now steal, but the actual mechanics of it we'll obviously follow up once the detail is published.
Yeah, brilliant, thank you, Ali. Next we've got investment properties.
Yeah, this one did shock me, actually. I really didn't see this coming. So investment properties, so anyone owning a second house, they're going to reduce the CGT from the higher rate payer from 28 to 24%. I think his idea is then to stimulate the housing market, because we've got properties here that people may be having have a second property, and it's tying up those properties, particularly in maybe the areas where second homes are causing an issue for residents, where these houses are not used all of the year. So this is to kind of spark the thought that selling it's not going to be such an onerous tax bill. It's the flip side is they've reduced the capital gains tax allowance in the year, so automatically more of the gain is chargeable, so they're reducing the higher rate from 28 to 24 to make that sale potentially more appealing to people. It is on residential properties only. It's unlikely to apply to your main residence because there's already a significant relief applying to that, a principal property residence relief. So you sell your own house, assuming it's never been used as an investment during its time of its ownership, it's likely to be fully covered by the exemption anyway. So this CGT charge will apply to second homes. Interestingly, it's a good reminder point, actually, that anyone that is selling a second home, they do need to register for CGT online. So you need to do a CGT return, which is due within 60 days of the sale of that house. That property. Back in the day, they used to just go on your tax return at the end of the year and you would pay the tax the following January. That has changed. It's been a couple of years, but it's one of those things that if you don't regularly sell houses, which many people don't regularly sell an investment property, might not have come across it, but it's a good point here to remind people that if they do sell a residential investment property, do need to sign up and get that return in within the 60 days, which obviously we can help you with. But I suppose the key thing here is that it's coming in from the 6th of April, which is just less than a month. So I would definitely consider the timing of any, if you're in the process of selling, worth considering that 4% reduction, what that would mean to you.
Yeah, I think that's brilliant advice. Also, the 60-day rule, I think that often does get that could get forgotten about. So brilliant reminder on that. But yeah, we find quite often recruitment business owners do have alternative
Yep.
investments as well. So I think this could be a great saving for some of our recruitment business owner clients that we have. And
Yeah,
VAT registration.
that registration. Well, this hasn't gone up for, I believe, 7 years. I think that's right. I think I'm right in saying that. Yeah, so it's now, they finally increased it from 85 to 90k. So what that means is, I guess, for recruitment startup businesses, they've got a little bit longer before registration is compulsory. So this first 90k is in the first year on a look back basis. So once they hit 90k within a year, within 12 months, they need to register, but they've just increased it just that little bit. It's just a little bit of a buffer there. Interestingly, probably more interesting for me actually, is the deregistration threshold for people who are reducing their business size. Then that they've increased that as well. Up to 88. So that's interesting. Probably not relevant for most of the people on this call today, but if there are startup businesses, their VAT registration is one of those things that often people debate at the start of their business journey. Do I register now when it's not compulsory? Do I wait until I need to? How will it affect my margins? So it's just useful to know what that limit is. So you know that you've got 90,000 before you have to register.
Yeah, definitely. I think I talked to quite a few recruitment startups. This is one of the most common questions: do I register for that now, or do I wait? I tend to say voluntary register most of the time, because you normally work for big corporate clients, so you can reclaim the VAT back on any sales anyway, and then you get to reclaim all the VAT on your purchases. The other thing to think about with this as well is if you've got any limited company contractors on your books. They may need to be aware that this has changed, depending on how much they're earning. But just a thought there. I think there's a couple of other things mentioned in the budget actually about full expensing in the budget. Is this something that's going to affect recruiting business owners?
Well, quite possibly. So full expensing is available. It's a limited company relief only, so it's not for unincorporated businesses. So they brought the full expensing in last year, and they're still talking about it now. And it means that you can set off the cost of all your asset purchases for 100% in the year of purchase. Interestingly, what they didn't mention in the budget was annual investment allowance, but they have previously made this a permanent allowance. So every business, and that's unincorporated has a £1 million annual investment allowance, which they can use to offset for 100% of general general assets. So you've got your computing equipment. I don't know if you've got the office, all your desks and everything like that when you're doing your office kit out. So we do have that £1 million as well. So that's also in there. So there is a lot of relief available for the fixed asset purchases. If I was looking at both, I think I'd still say that the AIA is probably a better option in the main course of business, because the risk with full expensing is that there's a balancing charge should you sell any assets, which isn't going to be such an issue on the annual investment allowance. But I think having those two things there together means that there's definitely 100% relief that we can use, businesses can use. Recruitment consultants, I think they'd struggle to get over the $1 million. So the $1 million, maybe for other businesses where there's $1 million isn't quite enough, so the full expensing is going to come into play. Interestingly, he did also talk about full expenses for leased assets, which you don't get AIA on. So that's interesting, but there is not much detail on that yet. So we're looking for what the documentation of that will be in the near future. But don't have details on how that's going to work just yet.
Okay, so in terms of recruiting businesses then, so if you're looking to kit out your office and spend quite a lot on, sort of like you say, desk computing, things like that, you can fully expense that against your profit and get full tax on all of those costs?
So yeah, we've got two mechanisms here that we could use. And I guess on a timing thing, that's quite interesting. We'll probably touch on this again in the planning, looking at when your year end is and spending the money ahead of the year end for maximising the tax benefits as soon as possible.
Yeah. You want to offset that as much as possible to reduce your corporation tax bill. Brilliant. Okay, thank you, Ali. We're now going to move on to pre-year-end tax planning. So if there's anything, tips and tricks to think about for before the tax year ends on the 5th of April, and taking into account any of those announcements that Ali has just mentioned. So this is a question that I get asked a lot about, and I talk a lot about to clients. So in terms of remuneration, what's best? Is it salary or dividends if you're a business owner?
Yeah. So I've heard this question years ago when the answer was obvious, and we'd go, oh, low salary, high dividends every day. Obviously, that did depend on having distributable reserves. Having after tax, still having reserves that you could pay out of. You couldn't do it before, but it was genuinely a one answer fits all. You're a profitable business. We're going to go low salary, high dividends.
Mm-hmm.
Definitely now it's much more on a case-by-case basis. We've got the increase in corporation tax rate that came in for the 1st of April last year. So the normal rate of corporation tax is now 25%, was previously 19%. Only companies with profits less than 50,000 are paying tax at 19%. And then we've got the lovely grey area of people paying marginal rate relief. They've got marginal rate tax, which is approximately 26.5% where you fall into that bracket, which I think will apply to quite a few recruitment consultants businesses. I think it's quite key. So on that, I think if we're looking at only having the owners only looking at taking out basic rates, so up to the 50,000 to 270, that under that limit, dividends probably still the best solution. The best idea is wholly dividends. Once you get over that limit, it's definitely going to be a look at it on every individual one, a calculation to make sure that we're maximising the tax efficiencies where possible, because it could be that actually a year-end bonus would be more beneficial to you. So dividends up to a certain level and then a bonus, as opposed to going into the higher rate of dividends. That bonus could well save you corporation tax. It might bring you out of the marginal rate relief. It might bring you into smaller companies tax regime, so saving potentially 6% corporation tax. So it's definitely one of those, we need to look at it, we need to take into the facts of each situation. It's not quite as straightforward as it used to be, where we could kind of plug it one spreadsheet and put everyone's information into a standard spreadsheet, and we could get a good feel. Now it's taking into consideration whether you're looking at keeping profits in the business, whether you want to strip out every pound from the business, whether you need that money for income, whether you don't need that money for income. So there's lots to consider. I think it's still very important to consider the spousal remuneration. You've got that on the slide there. If you've got one worker in the family, and that's the owner of the recruitment, and your wife is at home with the kids, then using her personal allowance is an obvious solution to using up their tax-free benefits. She can have an office in the be an officer of the company and be remunerated for that. Also worth looking at whether they're going to receive dividends as well. So it might be, if it's a case of being able to keep both of you underneath that basic rate band, that might be a good stepping stone whilst you grow. And then once you're both going over that, then it might be looking at actually, do we replace it with a bonus at the year end rather than increasing those dividends? So it's definitely, it's definitely not one answer fits all anymore.
I think that thrown it with the change in NI as well. I guess that makes a big difference as well, doesn't it? You've got another saving there to think about.
Exactly, because dividends were always, it's an obvious choice. Well, back in the day, everyone got a tax credit, so it was a big, when they first brought in the dividends, or they first brought in the dividend allowance, that was a big shock to owners that were paying high dividends and low salary. That year, I'm sure you'll remember that, Marie, that was the year that everyone came back and said, this can't be right, you've done something wrong on my tax return here, I'm no longer pay tax. And this situation is the dividend allowance is being squeezed. It's now £500 or will be £500 next year, and so those things are taken into consideration, because yes, you don't pay NIC on it, but NIC is falling on earned income. So there's all these things to now take into consider, that no longer one size fits all. I mean, having said that, I would say that for basic rate payers, it's very likely that dividends will be the answer for a profitable business. It's once you get over that we need to look at all the different areas, and there's non-tax considerations to bring in as well. Like, do you want to be what do you need the money in the business for in the future? Do we need that money there? Do we need to be stripping out all of the post-tax profits? Do we need to be thinking more? Do we need to be increasing the salary so that we're getting the benefits but leaving some profits in there as well? So there's various difference, and we can run through all those scenarios if people want us to.
Yeah, I think also thinking about whether remortgaging and things like that, that's always a question, isn't it? It's, is salary better to have on your P60 for your mortgage application? While you mentioned about dividends, we've got a slide here on the dividend nil rate. So what for those that aren't obviously accountants on this call, what's the tax implications of taking dividends from the company?
Yeah, so basic rate tax dividends, they get taxed at 8.75%, which is obviously much, much lower than the salary taxation, which is 20% for that rate. So it is, that's why I'm saying that, I think that sort of backs up what I've just said, that when you're in that basic rate band, 9 times out of 10, the dividend is going to be the cheaper way for you to take the bulk of your remuneration. However, you get into higher rate and you're looking at 33.75, that's much closer to the 40 that you could be looking at, bearing in mind that that higher salary could save potentially 6% on corporation tax. That's where it might be that we do a mix of bonus and dividends above that level in the higher rate. And then the additional rate even higher than 39.35, and these are creeping up. The weird maths is where they started when they had a dividend allowance of 5,000 and they worked the percentages out on that, and obviously they've crept these dividend allowances down, so now we have very weird percentages.
It's odd, isn't it?
Yeah. But interestingly, it's going down again because they're heading towards nil. They're heading towards no nil band rate for dividends. It's going down to 500. This is the last year where it's substantial at 1,000. And as I said earlier, a big shock for people who always receive dividends when they first brought this new regime in a couple of years back, because you went from paying very minimal year-end tax to a significant tax bill. And obviously, every time they creep this dividend, the nil rate band, that tax bill will just get a little bit higher, even if your earnings have remained static. You'll be paying a little bit more tax than you were the year before, which is interesting, which is, I guess, the criticism of the budget as well, that yes, he's reduced NI by 2%, but overall we've got the fiscal creep, haven't we, where more people are being dragged into a higher rate tax banding because their salaries are going up, but the bandings aren't moving. So yeah,
I think it's quite a sneaky way, I think, of bringing in more money for the government, I think, with taxes, because you don't really see a clear tax increase, but you just think, oh, the bands haven't changed, okay, fine, and then it's like, oh, I actually pay more tax now.
Absolutely.
And then pension payments, sorry. So yeah, this is another tax efficient way of drawing funds from the business. So Annie, would you mind just talking through why it is tax efficient and what people can think about before the tax year finishes?
Yeah, absolutely. So corporation tax relief for pension payments, and definitely what with that increasing now to 25%, it's a really good idea. So they increased the threshold to 60,000 last year. It was previously 40,000. If you've had an existing pension in the past, if you've got a pension that's been going a while, there's potential there that we could carry back and put profits, make payments in respect of the 3 years before. That's not going to apply to everyone, but it's something there to be explored, because it could be really useful to people who haven't had cash. Maybe they've had a good year, they've got some profits, they've got surplus cash in the business, they don't want to take more income out, but equally they don't want to pay corporation tax on the profits. This is a nice deduction against corporation tax, so worth looking at. Obviously, it's a way of making your business pay for your future as well, by investing in when you're no longer working. If you're the owner of a recruitment consultant at the moment, that's giving you your livelihood. Once you cease to be that earnings, then your livelihood isn't there. So what the pension's doing is building that pot in the future for you, whilst giving you a tax saving at today's date. There's no charge on you individually when the pension goes in, as long as it's not exceeding the 60,000. And on the basis that your threshold income doesn't exceed 200,000. If it does, there's various rules there, but for the majority of the people that we're working with, I think this is a really useful relief. It's a good way. It works very, very well if you have surplus cash and you don't want to take that out either as a dividend or a bonus. You don't need it to live now, but you don't necessarily want to leave it in the business, and you want to save tax. Interestingly, to get the tax relief, it does need to be a cash payment made before your year end. So it's not something you can accrue for. It's not something you say that you want to pay and you put it in your accounts as a provision. It does need to actually be made in that financial year to get the tax relief in that year. So worth talking to Maria or myself about when you're doing your year end accounts and the timing of those pension payments to maximise the tax efficiency.
Yeah, I think it's also worth noting it's not necessarily based on profit like in dividends, where you have to have profitable, be a profitable company to pay those dividends. You can actually, if you've got the cash, you can make these payments regardless. Yeah,
absolutely. So if the case that you'd be relying on a bigger salary or a bonus because you don't have it, but you had money for a bonus, you don't necessarily want to take the money out. The pension would be the other obvious choice. Put it into the pension, saving it for the future. There's no tax for you on the way in, but there's a significant tax relief for the company at today's date, and that grows for your future, which is what they want. They want everyone to have a nice big pension pot.
And then mentioned about electric cars. This is something that comes up quite a lot. I know there's quite a few recruitment business owners that I know that have actually taken up on this, but electric cars are something that are quite beneficial to put into the business because of the benefit in kind tax charge. So how does that work, and why is it more tax efficient to put an electric car through your business as opposed to a diesel or petrol car?
So they've continued with, we know that for the next year, for the next 24 months, that the benefit in kind rate is going to be 2%. It does start to creep up after that, but important to note, this hasn't been enacted yet, so we can't really speak beyond that. However, at the moment, if a company buys an electric car, it will get a full year allowance on the capital allowances, so it's not eligible for annual investment or for full expensing. Cars are specifically not eligible there, but they are eligible for first year allowances because of the fact that they're electric, and we're trying to push the electric environment, the use of electric cars. So the company will get 100% tax deduction the price of the car. And then the person the individual using the car, whether it's the owner or it could be one of your your key employees that you want to reward, they have a very low benefit in kind. If you think the benefit in kind percentage for non-electric cars, I think is up to 37% now on the value, whereas here you're looking at a 2% on the value. It's a very attractive benefit in kind. It's a cheaper way for your employee to run an electric car.
Yeah, I think also that's a really good point about the fact that you can offset you can get corporation tax relief on the cost of the electric car if you buy it in your business as well. But yeah, okay, thank you, Ali. Sorry.
No, I was going to say it only applies to electric cars. Don't do it with petrol or diesel cars. Only electric cars.
Yeah, be stung. And moving on to R&D tax relief, this doesn't really affect many recruitment businesses, but it does affect a handful. I just wanted to pick up on this because I know there's a change in terms of how the R&D schemes are being run. But how does R&D work? So what would a genuine R&D tax claim look like for a recruitment business, and how does it work for them?
Yeah, so what we're looking for here is, well, HMRC will accept a claim where it's a qualifying activity, and it's addressing a situation where a company's addressed and got over a scientific or a technological, that's a difficult word, uncertainty through the use of research and development. So where the company has invested money to get over one of these hurdles, and therefore they've actually produced something where they've produced a solution to a technological or a scientific uncertainty. They've become much more, the regime has become much more scrutinised, I would say, by HMRC, and they do look at projects. They will challenge whether they think it's actually commercial rather than overcoming a technological issue. So for that reason, we work with a partner, Easy R&D. So they are experts, and they will work with on a one-to-one basis with clients to look at whether or not the expenses that are in question would be qualifying. I think that's a really important thing. You want to know that when you submit a claim, the eligibility of the claim is correct.
Yeah. So this is for a recruitment business, the type of thing that may have a potential is if they invented a new system, like a new candidate tracking application or something, you know, like a CRM database or something, that they've sourced IT contractors to come in, develop something that's a unique system, and they could claim and get some relief on those expenses.
Absolutely, potentially, but I think it's one of those. It's worth having those conversations with Easy R&D, who would be that would assist with a competent technical person role and ensure that that the project itself is meeting the criteria.
Yeah. Okay. Thank you, Ali. And then moving on to capital gains at the annual exemption. I know you touched on this earlier when we were talking about the change in the percentage. So what people can think about if they are looking to sell an asset, what do they need to consider before the 5th of April this year?
So up until the start of this tax year, the annual exemption was 12,300, which meant that a lot of people would sell assets and not even think about capital gains. They reduced that to 6,000, which brought a lot of people into the capital gains tax regime, and that is reducing further to 3,000 from the 6th of April this year. So I think it's really important to, if you're selling something now, you do need to be considering which year you're going to sell it in to maximise those reliefs. You know, back when it was 12,300, often we would look at if you had 2 properties to sell, you might sell one either side of the 6th of April so that you would maximise that 12,000. Obviously, with the annual exemption diminishing, that becomes less attractive, but it is still a tax saving, and you want to make sure that you're using those exemptions. They don't roll over, they are specific to the year. So come the end of this tax year, the 6,000 will disappear and you'll be left with 3,000 next year. So it's worth looking at the timing of any sale of assets. Obviously, we've got two conflicting things here now, because we know that although up until yesterday, we would have been pushing people to sell any investment properties before the 6th of April, knowing that there's a £6,000 exemption. Now we know that the tax rate for higher tax is reducing from 28 to 24. Be looking at it on a case-by-case basis and seeing whether or not. But I think it's just a really important to remember that more people are going to come into this regime because of this annual exemption being reduced. So in the past, they talked about increasing, which is the opposite of what they did yesterday, increasing capital gains tax rates. And I've been telling people this for years, so everyone's going to say, you said they were going to go up, and they haven't. They've gone down. But this is a sort of stealth tax by reducing the amount that's exempt before bringing in. So what it does do is it does bring more people into the regime. I'll go back, I'll remind the 60-day CGT return again. So if you sold an investment property when the annual exemption was 12,300, there were people that the gain was fully covered by that amount, so they didn't have to do it. Obviously, if the gain from this at the moment, if the gain is above 6,000, next year, if the gain is above 3,000, they need to submit the tax return. So it's important to know what these limits are.
Yeah, I also there's a point on the slide about if you're married or in a civil partnership, if you own an investment property.
Yes. So the transfers between married couples, there's no CGT. So you can transfer to maybe benefit from using both of your annual exemptions if they're both unused for that year. So it's an important thing to address before you actually make the sale. Is there some more tax saving we could do here by splitting the ownership before we do it?
Yeah. And I guess what comes under capital gains is business asset disposal relief. So entrepreneurs relief, that it's still quite commonly known, I think.
Before your time, it was retirement relief, but I remember it.
But this is about when you sell a business and you can get a really, really reduced rate of 10% on the gain that you have when you sell the business. And I think there's been rumours that have been flying around for some time now about whether this will be scrapped or not. And I think, if we're looking at the election that's coming up, possibly there could be a higher chance maybe that Labour might come in and what that might mean to this relief. So have you got any thoughts on that, Ali?
Well, anyone on the recruitment base for our recruitment class who has spoken to me in the last 12 months will know that I've been preaching this as coming, the doomsday for BADR is post-election. I don't have a crystal ball. I couldn't tell you. I suspect it will be reduced again. That is and everything we're doing at the moment, when we're dealing with any business sales or anything at the moment, no one's hedging their bets. We're going with the rates we know today. So we're taking advantage on the basis that we firmly believe that the capital gains tax is at the lowest that they're going to be. And the obvious move post-election with a new government is that they become more equal to the income tax rates. And that does mean potentially the business asset disposal relief may well go as well. So for those people that don't know what business asset disposal relief is, if you sell your business, you have a qualifying business, you have 10% charge rather than a 20% charge on the first £1 million. Many years ago, it used to be 10 million. It's reduced to 1 million, but that's the first £1 million on that sale will be taxed at 10% rather than 20%, which is quite a significant saving. And that's what I think people are keen to know, that if they're in the process of selling and they're looking at exiting their business, when do I do it? And I suppose if you have a deal on the table now, you're kind of comfortable that you're going to get that business asset disposal relief. If your deal is post, I'm going to say November as an election date, maybe, then we couldn't promise. But we're working on the basis, and everything we set out is working on the basis that it will exist, but there is obviously that risk that it won't. Useful planning point, I guess, is that working on the basis that it does continue to exist in some guise, because it has always, retirement relief, entrepreneurs relief, business asset disposal relief, BADR, I also heard it called, which I don't like, but BADR. At the moment, there's a 2-year qualifying period for that for shareholders. So people who are looking at exits maybe want to be looking at the way that their share structure is held, so that they'll maximise the amount that will be taxed at 10% rather than the higher 20%. Because it could even be that if they put the rates up, they keep the business asset disposal relief, but that becomes 20% and the other rate becomes, so it's still, I think we still have to work on the basis that a relief in some description will exist, although we don't know the percentages. And so we work on the eligibility requirements now. So at least if we've got them in place, we stand the best chance, if they still exist in some guise, of being able to access them in the future.
Yeah, I think that's a really good point, because what we touched on earlier about spousal remuneration and possibly bringing a spouse into the business and having some shares so you can share your dividend allowance with them, or your thresholds with them. If they're not an appointed
Officer.
That's the one, officer of the company, then they may not qualify for business asset disposal relief. And I think that's be quite easily missed by a lot of businesses.
Yeah, absolutely. And because a lot of people think, oh, exits are in the future, it's not something I need to think about today, but it's good to set up your business for an exit. Even if an exit is 5-10 years down the line, set up as if you are going to exit, because then you're going to maximize the benefits when you do. And there's nothing worse than working on a deal with someone that hasn't made those changes. The deals come on them quite quickly, and then they're like, oh, if only we'd set it up like that, we would be getting this. So yeah, we're happy to go through those sort of structures with people to set people up in the best position they can possibly be in before that even becomes an option.
Yeah, definitely. And the other thing that wasn't actually mentioned in the budget yesterday at all was EMI schemes and EOTs, which I'm guessing nothing's changed around.
Absolutely. Yeah, so the good news is they're still there. They're still really valuable for recruitment businesses. If you've got some key personnel in the business and you're looking to grow the business and you're looking to incentivize, maybe you don't want to continually just offer them bonuses. You want to look at somehow bringing them in to having a part interest in the equity in the business without actually giving them any equity. So EMI options are there. They're a really good incentive. They'll align your thoughts of the growth as a business owner with the employees, so that you're all working towards the same growth. They know that they're going to benefit from all the investment they're putting in, even though they're not going to become shareholders necessarily in your business, but they'll benefit from a future sale. So really useful. And yeah, very interesting what wasn't in the budget. And EMIs were not, which is useful because there was quite a bit last year on EMIs. They did change. They actually simplified some of the regulations which are actually coming into play in 2024. So, but no, I think it's still a really interesting conversation to have with recruitment consultants. What can EMIs offer for the business? How can they help me grow? How can I incentivize my staff? It's a really good option. And EOTs, again, nothing mentioned on EOTs. They're really useful. We've seen an increase in the appetite for EOTs. They've been around in the guise they're in since 2014. Anyone who's seen me on LinkedIn will know that I do a lot of work on EOTs. So yeah, we've seen a significant interest in EOTs. They're becoming a really good exit strategy for businesses that have set up with a good second layer of management who are an obvious choice to take over, and might provide an easier exit option for the business leaders that want to exit. They mean that you can leave the business without actually having to find a third-party buyer, and not necessarily having to find a third-party finance as well. So if it's a good option to look at. I should probably say what EOT stands for, because I haven't done that. It's Employee Ownership Trust. So anyone that's like, what is she talking about? So they're also really useful exit planning. It's a good conversation to have. So put those options out there.
Brilliant, thank you, Ali. I started that conversation by referring EMI and EOTs as well, so that was my fault.
I know I've done that thing I hate, where people talk acronyms and I don't know what they are, and I'm desperately trying to Google what the acronym is. Yeah, so incentive management, enterprise management incentives was the EMI options, and employee ownership trust for EOTs.
Brilliant, thank you, Ali. So that brings us to the end of this webinar. I just want to say a huge thank you to Ali. That's been super helpful. You're running through everything, and it's nice to have a tax expert that can actually explain things really clearly, even down to the acronyms that we're using, and seeing how they affect the recruitment industry. So I just want to say thank you everyone for attending. We will be following up with our contact details and a recording of this webinar. And if you've got any other questions or anything, please feel free to touch base with us. Our contact details will be on the follow-up as well. Just before we go, I'd just like to announce that we have published our recruitment sector outlook document for 2024. It's a pretty comprehensive document with loads of articles and various different recruitment experts with lots of advice and tips for 2024. You can scan the QR code now and download it, or we'll send you a link following this webinar as well. We will be doing more webinars throughout this year, so keep an eye out for emails and social media posts. And we'll also be attending the Recruitment Agency Expo on the 19th and 20th of this month. So if you haven't signed up already, and we have got a stand there, so come and say hello if you are there. And that's all from us today. Thanks very much for joining us, and thank you, Ali, for attending. And I wish you a great day.
Have a great day. Bye.